you doing today?
I'm fine. It's a beautiful sunny day here in Puerto Rico,
Okay.
which is also tax haven for Americans. So, life is good in the tropics.
Well, lovely to hear that from where you are, right? Here we're in BC, with the beautiful British Columbia. It's not too bad to have for today's weather, but nothing compared to where you are over there for sure.
Well, we don't need to get distracted, but it's not the weather for me. It's the taxes on April 15th. I'm so happy to be here.
Indeed. So we have quite a few topics to cover today. And let us start with before we go on to the headline these days, of course, about the banking crisis. Let's talk about a bit of a background here on inflation. That's sort of the headline in the last 2 years. Are we near the end of it? Do you think the governments did enough, or is it early enough, or too late, or in terms of tackling the inflation, high inflation rate this past 2 years?
Kind of yes, no, maybe in that order. I think clearly with base effects, and I think the audience doesn't need that explained to them. It's very difficult when you had plus 7% or more inflation all of last year for it to maintain a very high level on top of that, right? Inflation is additive, right? The inflation rate is on top of what was before. So, the base effects alone are an argument for what is optimistically called disinflation, though I think that's actually disingenuous, because nothing's getting cheaper, and it's wrong to make it sound like it is. But it's hard to have a higher rate of increase on top of a very high rate of increase. So that was, I think, quite predictable. We're seeing that. Doesn't mean anything's getting any better. My analogy for this is like you're mountain climbing and you come to a really steep cliff, and then you get over the hump on the cliff. You're still not at the top of the mountain. You're still going up, but you're not going up as quickly as you were before. And so the rate of increase is not as high. And people say, oh, peak inflation, peak inflation. But in fact, the peak is still quite in front of us. So long story short, what I'm saying is we're not anywhere near done with inflation. What the government has done, I think it's partly the wrong medicine, only partially addresses the issue. You can't control a monetary phenomenon with just the interest rates like that. I mean, a money printing phenomenon. Now, M2 money supply has gone into reverse, which is relevant, long and variable lags. So many things, many ways we can tease this apart if you like, but the message is, expect higher for longer to apply to inflation much more than the Fed's policy. And that has investment implications for all of us.
Interesting. So I guess as a result of that, right, because with what's going on with the sort of drastic increase in terms of the interest rates, trying to slow down the inflation. So suddenly, is it not a surprise for you to hear that recent news of the collapse of one of the banks, or is it sort of surprise or not surprise to you to hear that?
Not at all. And I'm not going to pretend that I knew that this specific thing was going to happen. I didn't predict, the banking crisis of 2023 as such, but and it's not just me. I'm not trying to make myself the big guru here who knows everything, but anybody who has any degree of skepticism or maybe even just experience, even mainstream commentators were saying the Fed is likely to go until it breaks something. That is its track record. It raises things until something breaks, and now we know what the something was, or at least this is the first something here. And if you think about it in retrospect, it seems kind of predictable in a way, but there's so many things that it could be. When you're surrounded by a flock of black swans, it's hard to say which one of those suckers is going to come in and land first. So yes, I think this is entirely to have been expected. Which one it was, could have been any one. This perfectly fits the pattern. It makes absolute sense in hindsight. Everybody's saying, how did we not see this coming? Well, there's any number of candidates, but I think the key point, though, and relating it to your first question, is that it keeps going until something breaks, and then it has to pivot or loosen up at least, or pause at least. But they were hoping, I think, and the mainstream was hoping that they would have made a lot more progress on inflation by now. That we're nowhere near the 2% goal, not even if you have the core or the super core. They keep throwing out all these things, not important things like food or energy, to try to reduce the number and the target. but even those are well above target. And so if you're starting to look at systemic risk forcing the powers that be to loosen up on policy well before they've reached target, well, then you got a problem. Then you're really looking at something that sounds a lot more like the stagflation in the 1970s. And if you recall, in the 70s, there was that big shift in the middle, right? Arthur Burns and all that, they're famous for trying to, they did raise rates and then backing off when things went bad economically, and then that making inflation come roaring back again. For all that we know all this, for all that the Fed knows this, that Powell knows this, they all know this, it looks like they're on the road to making the same mistakes.
Wow, that can be quite detrimental. So what's the thought? Do you think this is just the beginning? I presume what you just mentioned is not gonna be the stop right now with the Credit Suisse, one of the bigger names being taken out. There's probably more things to come, maybe, or
yeah, I think, well, one piece at a time. I do think that the situation with the regional banks in the US is, it's not the same as what happened with, say, Silvergate or something, a more purely crypto associated bank. And even SVB is more idiosyncratic than First Republic or Western or Pacific Western. There are differences there. But you can't just say, oh, well, this one's different from that one, and then this one's different from that one. And well, Switzerland, that's all the way over there. If you have a string of bank failures or serious bank blowups in the course of a couple of weeks, clearly something is going on. And it's not too difficult to look at this around the world. What's happening? Well, central banks around the world are tightening. So I'm not saying that there was a contagion from, SVB to Credit Suisse. But I'm saying there's a commonality of cause here. And aside from what the powers that be may do with policy, there's also just human psychology. We shouldn't forget this. And it's striking to see even mainstream analysts, on Bloomberg or Yahoo Finance or whatever, they will mention that banking rests on confidence. If people lose confidence in the bank, it actually doesn't matter how strong the bank's balance sheet is or what the backstopping may be or what insurance levels the governments may provide. If people decide that they're nervous, they don't know what's going to happen, but they're nervous enough that they just decide in significant numbers to take their money out of the bank, that bank's done. It's just, you can't stop that. I'm not predicting this. I'm not saying, oh, all the banks are going to blow up.
Yeah,
head for the hills. I'm just saying that there are limits to what, those who imagine that they control the levers of the economy, they think they can set policy and everything will go the way they plan. It's just not so. Some things are out of their hands. And, if you think about it, we've got a war after a pandemic, major body blows to confidence in the global economy, the way things are. And not to be a populist, but on top of all this, you've got banks posting record profits not so long ago, the 1% versus the 99%. The 99% doesn't trust the 1%. So if you don't trust them, you don't like them, and suddenly they're having trouble, the bankers are having trouble. It's easy to imagine a situation where mass psychology does its own pivot and takes the decision right out of the hands of the powers that be. So interesting times.
Indeed. So yeah, I agree with you. So the power, the authorities is just trying to create or at least offer a bit of try to show enough confidence, try to say, hey, anything you do, we'll match it. You go ahead, you can withdraw all you want, but it's all covered, so don't need to worry about it. But as you mentioned, things can go really south, and it's hard to control how the mass will do or what not to do, right?
Yeah. One key point here, and to give credit where due, my fellow Puerto Rican Peter Schiff is the one who's really been pounding the table on this, and so I want to tip my hat to him on this. The government can guarantee all deposits if they want to. They can print the money. If all the money goes away, they just print more, like Doritos. We'll just make more. Right? So they can make sure, you put millions or hundreds of millions in the bank and it disappears, they'll just print more. They can replace your money, right? They can guarantee that you'll get your money back. They can do that. What they can't guarantee is that that money will be worth anything. Because if they do that, if trillions disappear and they just print more and replace them, what does that do to the value of those trillions? So, I mean, that is, again, something they imagine that they control, or they pretend that they control, but they really don't.
Yeah.
So yeah, beware of these guarantees and what they mean and what they don't. They can guarantee nominal replacement, coverage, but they can't guarantee value that is beyond the power of any politician, bureaucrat, central banker, anybody.
Yeah, so now let's spend a bit of time talking about the gold and commodities, which is our main focus. And gold has been performing reasonably well this year. And so is that the main reason why we see gold has been performing? Because nobody really trusts the financial system anymore? Is that one of the main reasons? Or?
Well, in the short term, well, there's different terms here. In the immediate term, clearly there is fear driving gold right now. When you see gold and the dollar moving up at the same time, which we have seen at various times over the course of this month, then that is always a sign of the fear trade. In particular, we saw, last week we saw when the big scare, before the powers that be really kind of calmed the panic on the banking front down, we saw bonds up, rates down, bonds up, dollar up, gold up strongly at the same time. That was clearly fear. And there is fear right now. People are unsure whether the powers that be are going to be able to, kick the can down the road, smooth things over or not. So that is absolutely part of what's happening. Now, that's in the context, though, the more sort of midterm of, a currency devaluation, what's happening with the dollar. Over the last year, we have seen the normal relationship. Gold is multivariate. There are many things that can make it go up or down. But the most powerful explanatory variable for 50 plus years since the US terminated, any last vestiges of relationship between gold and the dollar, the number one explanatory variable has been real rates. Not the only one, but the most powerful one. But over the last year, that has taken the back seat to directly people trading versus the dollar, like the traders, the people on the comics in London, looking at the DXY in particular. And the inverse relationship, it's like a Rorschach ink blot between the DXY and gold on an intraday basis. It's striking how close that mirror image is. So what determines the DXY becomes the gold speculator's question at that point. And the DXY, I see it right now as a question of relative hawkishness and dovishness of the central banks. When it looked like the Fed was, when the Fed was leading the way in tightening, the dollar gained strength last year. And alternatives, including the euro and gold and silver, took it on the chin. When the Fed started looking like it was easing up, and while the Europeans still had a lot more work to do fighting inflation, then the dollar rolled over. And that was beneficial to alternatives like the euro and gold and silver and so on. So that's, I think, the question right now, apart from the fear. If the banking thing goes away, if the immediate fear goes away, then we're still looking at what happens to the dollar vis-a-vis other currencies. What's the relative hawkishness of the central banks? And we've just got fresh data on this. Just yesterday, we had the Fed go with 25, when earlier the ECB went 50. And just today, as we're talking, the UK tightened 25, which by UK standards is quite a bit. Switzerland tightened 50, which by Swiss standards is huge. So you've got the banks in Europe acting more hawkish and the Fed sounding less hawkish. You've got more of the banking trouble here than there, which also argues for a more dovish view. So I think the thesis that, at least in the months ahead, the near to midterm, that the dollar has probably topped and we're looking at dollar weakness, that's also bullish for gold in this environment. And then longer term, you've got the big picture of monetary phenomenon, always and everywhere, monetary phenomenon, inflation, long and variable lags, all that stuff. Yes, M2 has rolled over in the United States for now, but there's still a lot of that pig to go through the python. There was still so much money printing done that I think that we're not done big picture with inflation for a long time. And of course, if systemic risk causes the Fed to go back to easy policy, and we start printing more money, let alone if Congress kicks in and there's some more fiscal stimulus, then all of that I think is very bullish for gold. Now, just quickly, I have to say, I'm not saying that there is no bear case. I'm not saying that it's impossible for gold to go down. We just kissed 2000 again. It's very exciting. But anytime something goes up like that, it's natural for there to be a breather, some pause for consolidation. Now, a more fear, another big bank failure could just make gold just spike right up and keep going for a while. But things could calm down. We've had our data points for a while. The market could chew on it. I'm so bullish on gold and silver. It's still a monetary metal. I'm so bullish, but I just don't want anybody to feel like I'm promising that they can't get hurt if they pile in now. And that's the point that I'm saying. I just, as a speculator, as a disciplined, value speculator, it's very difficult for me to pile into something when it's just hit a topical high. Markets are volatile. Markets fluctuate. So my advice to anybody new to this would be to look for volatility, look for any kind of correction for a buying opportunity, particularly if you're in the stocks, because they will magnify, if there's a little bit of a pause in gold, there'll be a huge pullback in the stocks. People go say, oh, that was it. Gold's peaked. It's going down from here. It hasn't peaked. I think that would be a gift for anybody that's late to this party.
Great to hear your bullish thoughts. And so besides gold and silver, so any other commodities that you track have good growth potential? Or how about uranium? Is that something that people should take a look at a little bit this year? What's your thoughts?
Well, let's talk commodities broadly first and then come back to uranium. I am in the stagflation camp, as I said earlier. That implies at least weak growth, if not actual recession. And in this case, I think we're going to get recession and inflation, which many mainstream economists think is just not possible. By definition, they think that you cannot have the two at once, even though history shows that it is quite possible to have both at once. In their models, the way they see the world through their models, it's like the weatherman who never looks out the window. They just can't see this coming. But the implication, though, for commodities is more complicated, because gold and silver, they're monetary metals. It's not like pork bellies or coffee or something like that. They have a use case that is separate from economic strength. Not so with copper or lithium or steel or iron, anything else. So if I'm right and we're headed into recession, I think we're already in a recession, even if the powers that be won't recognize it. And I think we're going to head deeper into recession until that becomes undeniable. So at the point the recession deniers give way, historically, that is always bad for commodities prices, even if they're already on sale. Like, it is not good enough to say, oh, this is below the cost of production, like uranium right now. Uranium prices have risen, but they're still below the average cost that the industry as a whole needs to prevent liquidation, let alone growth. So the fact that is the case for uranium will not prevent uranium prices and uranium stocks in particular from going down if suddenly people go, holy cow, we really are going into recession. It's here. What happens when people make that realization? They sell energy, they sell stocks, they sell commodities. All that stuff gets whacked in the face of that realization. So again, don't get me wrong. I'm actually very bullish mid to longer term. All these larger economic forces we've been talking about, I think are very bullish for commodities writ large, particularly the ones that are looking at structural supply constraints like uranium and copper, and down the road, lithium, perhaps some others. But I just have a hard time advising anybody to have a long-term view and just step in front of an oncoming truck in the form of this recession awareness. My experience is just that, the value proposition can be as solid as you want, but it will not prevent the commodities or the stocks from getting whacked in the face of realization that recession is upon us. Now, I will tease apart uranium a little bit because I do see that as fairly separate. Unlike, say, copper or especially lithium, which is still, despite the correction, quite high. We're looking at $4 copper as you and I speak. The better copper miners are making tons of money at that price. Never mind lithium and so on. So most commodities can easily correct from where they are, whereas uranium is still below the cost of production. The average incentive cost the industry needs is estimated to be around $60 to $70, and we're looking at $50 uranium. So I just said that won't prevent the knee-jerk reaction from sending prices lower, but I do think that really does make uranium different. We may get a knee-jerk reaction from prices to drop briefly, but ultimately reality will assert itself. And I'm not talking someday, some year in the future. I think what can happen is that the spot price fluctuates low because of these recession fears, and the uranium stocks can drop because of recession fears. But the long-term contract price for uranium, that's not set by any of this. This is set by miners and power companies sitting down at the table and negotiating these contracts. Those are already coming in higher. This is something that's not a someday future, guess or projection. This is something that's happening now. And the miners are just not going to sign contracts at prices they can't make money in. So it almost doesn't matter what happens in the economy or the spot market in due course, because the miners will sign only at prices that are profitable for them. I think that's higher than the prices that we have now. And I can see a situation where the recession is bad for other commodities for longer terms. And then as the reality sets in and as more of these contracts are made public and people see, oh, uranium's different, right? The spot price can vary from the long-term contract price in uranium, but never for too long. So that's the difference there. So yes, I'm extremely bullish on uranium, but in the very nearest term, I've told my subscribers that, you know what, I'm not just bullish for the future, but for 2023, I'm bullish on uranium. But with the banking crisis and the potential fear just causing a waterfall event, like we like to say, we know that uranium will not be exempt, even though it should be. And so, the odds are disproportionate. It's asymmetrical. If we wait a week or two, just a couple of weeks, and there's no big meltdown, there's no big crash, everything's fine, I don't think uranium stocks are going to double and, just run away from us forever. Whereas if we don't wait a week or two and we get this big waterfall event, we'll all be wishing we had just been a little bit patient, just a few more days. Yeah. That asymmetry, I think, argues for caution.
Yeah, so people should be really following what's happening with how the banking that transpire in the next, if there's more concerns or more fallouts coming in the next few weeks. I think that's a major.
It's a unique time. Like it isn't often so that, like there's something happening right now. Whether it's a banking crisis really or not. Yeah. But if it is, the risk of getting that wrong in the immediate future is huge. So it's. A speculator is not a wild gambler, in my view. A speculator, projects the future, but based on the trends in the data. And when you have such a big inflection point in the immediate future, I think discipline is the call word for the day.
Great. Well, that's one of the last question that I floated at you, because your brand is about speculation and sort of coincide with what we've been talking about too with our subscribers or followers for 20 years. Maybe you can define better than us. So Lobo, can you sort of say, hey, how do you distinguish the two, speculation or just gambling, in the stock market when you talk about it all the time?
Sure. Or maybe a three-way distinction, because there's investment. And it is true that there's a difference between investment and speculation. That one's easy. Investment is well known. It's deployment of capital for expected return. The difference with speculation is, I guess, the expected return part. It's more like hypothesized return. And if you're good at that, if you can spot trends before they're obvious, or particular, this is one of those things where it's funny. I think it pays to be an unconventional thinker, a contrarian, and understanding, a willingness to break with the orthodoxy, because that gives you the freedom to just sort of tune out the noise that you hear from the chattering classes on mainstream media and think things through for yourself. The difference between deploying capital for hypothesized return instead of expected return and gambling is that with gambling, you're really just throwing the dice. You're just like, why not? Or if, if you're one of these meme stock chasers, for example, by definition, that's not based on any kind of fundamentals. It's not based on, here's the trend. If it continues, this is where we're going, and I'm going to position myself to benefit. It's just, why not? This is popping. And, I could make $1 million overnight if I get lucky. right? That's like tossing the dice or playing blackjack or whatever. In other words, it's really up to random chance. There's nothing you can do to affect the outcome. That's the difference. And I'm not saying you can't make money gambling. Some people do. You get lucky. But you can't reliably do it. It's not a method. Or rather, let's say the professional gamblers of the world, they don't make their money by figuring out the roulette wheel. The roulette wheel, if it's an honest game, it's nothing they can control. They make money by playing the other players. The successful poker player, his odds of how the 52 cards turn up are the same as anybody else's, or her odds. The successful poker player is successful because they're psychologists playing the other players, right? There's a method they can apply. You can't do that, betting on meme stocks or whatever, gamble. Oh, this is exciting. Some guy on Twitter said, buy this, that's gambling. Whereas if you understand something's happening, say money printing, or you have some theory, and then you have the trend, the data that says this is happening now. But that's probably a really important point here. The theory isn't enough, right? People have had the theory that money printing causes inflation forever. I mean, the Austrian economics, this is what we believe in. And yet we see episodes of money printing and inflation doesn't go up. So it's not enough to have just a great theory that you believe in and it explains things. You need to look at what's actually happening now. Because you have opposition, and they have the powers that be have been great at kicking the can down the road, obscuring things. So I'm probably making too long of a thing of this, but this is, I think, something that really people should take to heart. If you want to make money as a speculator, there actually is work here. If you want to just gamble, if you just want to plunk your chips down on stocks or whatever, treat it like a casino, fine. But that's not what disciplined speculation is about. You do actually have to do your homework. You have to research. You have to do your own due diligence. Understand what you're doing so you can stomach the volatility, even make it your friend. Know when's the difference between averaging down in a smart way and throwing good money after bad. And if you do that, so many people are lazy, honestly. If you just commit to doing the work and being disciplined and doing your due diligence, you'll do better. 80-20 rule, you'll do better than 80% of the other people out there. And of course, I'd be happy to help with that if I can.
Yeah, good. Very glad to have you with us today, Lobo, to share your insights with us.
Well, thank you very much. Happy to help.